Prosper Trading Academy CEO Scott Bauer and EventShares Chief Investment Officer Ben Phillips. Susan, this notion that the underpinnings, as the administration has always pointed out, will save the day, that the fundamentals are sound, we're going to see more evidence of that, like the jobs numbers, et cetera. So everyone take a chill pill.
I think everyone should take a chill pill. We're not in a recessionary environment. Most people understand that we are moderating. Yes, that is true. I think the jolts, the job opening numbers proved again that there is still a strong economy that we see in the U.S. as we have 600,000 more positions available than people looking for work at this point. And when the Fed is forecasting 2% growth, that's better than where we've been for the last 10 years. So take a chill pill. We're still working out trade at this point, but there are some positive developments with differences narrowing, and we might get a trade deal before March 1st.
But you're not leaping in with both feet here, right? I mean, how do you describe your position?
No, I'm definitely not. And you know, I'm still very concerned. There's still a lot of headline risk out there. We'll see what happens tonight. But yes, the Fed has eased off a little bit, but nothing else has really changed. We haven't received any definitive news between the U.S. and China on tariff talks. Now, I don't believe we're in a recession. I think the economy is on solid footing, but I'm waiting for that next pullback, Neil, and I'm really looking to...
Would it be a pullback to the degree we saw last month?
I'm looking to see higher lows. That's where I want to see the stability. I don't think we're going to get to those bottoms.
How do you know those higher lows don't become lower lows?
Well, we've seen a progression here where we've seen 2 times in a row here where we've sold off that sell-off be a bit higher than where we were the previous time. I want to see that again, and I also want to see some stability. I don't want to see the VIX go between 19 and 30 on a weekly basis. I want to see us stabilize somewhere in probably the low 20s is the new norm, at least for the near term here. Then I know that things are probably, you know, at least for the next 3 months or so, going to be okay. I also want to see some solid earnings reports. Now, we're going to see companies come out, and they are going to address the tariff situation. But, you know, we've seen estimates come down to a level where most of these big S&P 500 companies, they should beat both top and bottom line.
Guidance is key. What they're doing in the next quarter and the next year.
100% based on the tariff issue. And that's the concern I have.
And the slowing growth environments and the credit environment that we're in when corporations have issued so much debt over the last 10 years. I think that's probably the biggest concern right now.
Well, that debt is a big word. Carl Icahns, you know, Ben, one of the numbers or the things that Scott follows is referring to the VIX or the volatility index, a gauge of fear. It has gone down quite a bit in this new year. Now, of course, it can swing like a Geiger counter here, but how closely do you watch that, this sentiment that seemed to be all over the map, certainly in the last month of last year?
Yeah, I mean, we're respecting the sentiment. I mean, one thing that we're noticing is institutional investors, there's a lot more fear in the institutional world than we're seeing in the retail. So if you ask an investor on the street, you know, are you worried about the market? They haven't shared their fears with us yet. But we talked to our peers, other investors. We're definitely seeing the fear level elevated on the institutional side. But I would point out, volatility has been fairly normal in 2018, actually almost spot on normal, 16% standard deviation in the S&P 500. That's the historical norm. It was just we got a little spoiled in 2017 and less than half of that.
You know, another thing that's kind of interesting, and it's early on in the new year, I grant you, but technology issues clawing their way back, having a pretty, you know, good year thus far. We've seen a lot of the small cap Russell 2000 stocks after getting bludgeoned last year come back in excess of 4 to 5% this year. Still early, I grant you, but what do you make of that?
Yeah, so the Russell 2000, I think, is very indicative of where we might be going, because they're saying small caps actually might be the place to be to hide if you had to hide, because
is that because they
it's
got
more domestic
overly
oriented
beaten down,
and it's more domestically oriented. They were the first to enter a bear market. They've rotated back. I think they've come back 10% since those lows at the end of December, close to Christmas time. So this is obviously a part of the market that people are looking to pick up some bargains at.
How do you play that, Scott?
I think you look at some of the banks actually in the small cap space, because yes, rates have come back down, but the volatility that we have seen in the environment over the last 3, 6, 9 months, that is good for most of these banks, especially the bigger ones. Maybe not so much the ones that are in the small cap space, but the trading volumes, the trading revenues that we should start seeing out of some of the bigger banks, I believe is going to lead to better bottom line production for them, but better revenue growth for them. I really like the banking sector after getting beat up, especially after seeing rates come in a little bit here.
Yeah, and then maybe the prospect of rates going up much higher, minimizing a little bit.
Do you think they are, though, in 2019?
Yeah, I don't know.
I bet Funds Future says we might see a cut, actually, in the first 6 months.
What. Do you see that happening?
I'm not so sure about the rate structure, but what I like is the trading environment. And if we remain, if the VIX remains somewhere around that 20 handle, that is a very robust trading environment for these big banks.
Yeah. Ben, I know every Wall Street titan with whom I chatted pays no attention to the government shutdown. They really don't. Not to a man or woman. They haven't raised it, which worries me because everyone's dismissing it, which means maybe I shouldn't. And yet everyone raises the prospects of a China deal, which might or might not materialize. And furthermore, even if it were to materialize, it might not be the paper it's written on, especially if China falls into a deep funk. Leaving that aside, are we being too cavalier about this shutdown and the implications, especially if the president declares a state of a national emergency, which is a very slippery kind of an area to get into?
Yeah, I agree that's a slippery slope. I mean, we've looked at past shutdowns. The market doesn't really seem to care until usually after 20, 21 days. So we aren't quite there yet, but we're approaching it pretty quickly here. I would point out, though, it's going to be a volatile Q1, we think. I mean, it's a big March. We have the end of the China, truce, if you will, expiring on March 1st. March 2nd, the debt ceiling limit expires. We got Brexit the end of March and the Fed meeting sandwiched in there. So it's going to be a really important March, and I think we're going to see some volatility up until then. I think, like Scott pointed out, the market's still trying to find its footing right now. It feels like it's found a little bit of footing, but it's still early days. The technicals are still pretty broken.
What I think, Susan, is when you see the president take that move, if he goes that far, and then, there's a full throttle effort to get a fence built and the military's involved, National Guard's involved, the reallocated funds involved, that's a big deal. That just the attention paid to it and the swamp of activity involved in it, that's a game changer.
So 2018 was the worst year since 2008. Before that, the last year the S&P fell, 2011. And that's when you had the government shutdown. That's when you had the credit downgrade. And psyches matter more than economics, as we heard from Jamie Dimon. So if you have this ongoing government standstill that's taking place and this showdown over wall funding, that's not a good sign. It doesn't send a good message to the markets. And I think that just creates unnecessary unknowns.
Wasn't that built in already? I mean, we didn't expect kumbaya from the Democratic takeover of the House.
You know what? Yes and no. And much to your point, Susan, is the market does not like uncertainty. Traders coming from the trading, floor trading background do not like uncertainty. That begets volatility. And there is so much uncertainty out here. And if this continues on, the psychological part of the market, the psychological part of trading is what will take over, at least in the short run. Emotions will run high. When emotions run high, what happens? People hit the sell button first. They sell first, and then they pull back and really think about it. So that is really what concerns me in the next probably 6 to 8 weeks with all of the risk headlines that are right in front of us.
All right. Well put. Final word on the subject. I want to thank you all.